Phyllis Nash. You out there?
So, guys, I could not talk. I have a terrible cold. I had to get Christian on the line to help assist me tonight because I thought it was so very important for you to get this information. This next young lady that I'm about to bring up, that's one thing I can say about this industry. I've known her now probably over 15 years. I know Melissa and I had an anniversary as well as Christian on the 6th, being 18 years. And I'm pretty sure Marsha Webb was there from the very beginning. But that's what happens in this industry where you find people, get with them. And then later, when you can call up and ask somebody that's an expert in this industry, not only a phenomenal leader in the industry of MLM, but also knows the tax laws like the back of her hand. And as you can hear, my voice is fading quickly, but there's no way I was going to reroute this, postpone this, or anything, because what you're going to learn tonight will absolutely help you in your business. And for the guest on the line, if you don't have a home-based business, you are truly giving money away. But I'll let Marsha tell you more about that. So let me put Christian, can you highlight her, please? And guys, you won't hear me anymore, really. I might have to ask Marsha some questions, but I'm gonna let Christian spotlight her and let Marsha take it away. Christian, are you there?
Good evening. Can you hear me okay? I think we're good.
Yes.
All right. Awesome. Well, Phyllis, oh my gosh, feel better. But that's what leaders do, right? Even when you are down, you're not down and out. You're going to make sure your team get what they need. So prayers to you that you get better soon. Thank you so much for inviting me tonight. This is something that I'm really, really excited about, really passionate about. And so we're going to make this exciting because when you think taxes, nobody gets excited about that. But what we're going to share tonight will and should excite you, especially with tax season rolling around. It's not too late. We have a couple of weeks left. There are certainly things that you can do. And based on what I've heard so far, I think we have some various people on the line tonight. You might be brand new to a home-based business. Maybe you're a veteran in a home-based business, or maybe right now you're just taking a look. Maybe you are an invited guest. And you're going to learn tonight why being in business for yourself, there's never been a better time in history to have your own, especially home-based business. We're going to specifically talk about that tonight because for many of us, the idea of going into business sounds fantastic, but the question is, where's the money going to come from, right? You need to be $1.5 million liquid if you wanted to open up a McDonald's to make $120,000 a year. Who's got time for that or money for that, right? So tonight we're going to talk about not only just this industry as a whole, but how the taxes favor individuals like ourselves who are in business for ourselves. So without further ado, I'm going to share my screen and I'm going to share a short presentation with you, a short PowerPoint with you, and then we're going to leave some time for some Q&A. All right, so we're going to go ahead and get started right away. So we're going to talk about your business and your finances. Now, we know there are certain ones on the line tonight that aren't currently in business for themselves, but what we're here to tell you is, again, there's never been a better time in history to have your own business. And with these leaders that are on this call tonight, they're going to make that very, very easy and simple for you. You're going to get what you need. What I'm going to talk about is the tax advantage of having your own business. So just real quick, excuse me, a little bit about myself. I have been in this industry for 2 decades and in the tax industry for over 3 decades. And it was just so exciting that 18 years ago when I met Phyllis and some other wonderful leaders, to be able to mesh the two together. Again, I'm just so grateful and so thankful for those type of people in my life. And so now what we're going to talk about, I'm not going to focus on me because I want this time to go to you guys. We're going to focus on what it means to own your own business. And in particular, a low overhead home-based business. So as an individual on the line tonight, you should have 3 primary concerns when it comes to your finances with your money: how you make it, how you spend it, and how you protect or save it. So the leaders on the call tonight that invited you, they're showcasing, they're showing you how to make money, right? I'm going to talk a little bit about spending money and how that translates into expenses or tax write-offs. And then I'm going to focus on how to protect and save that money. So those 3 primary concerns. So we're going to talk about strategies tonight that lend itself to building wealth. And you might say to yourself, tax strategies to wealth building? How? How can knowing tax strategies build my wealth? Well, ultimately, I want you to think about this. Think about whatever it is that you earn in your paycheck. If you work, whatever it is you earn in your paycheck, then think about what they do to it before you get the net check, right? Imagine if every dollar you earned, you got to keep. Wouldn't things change in your house, right? It might be a different vehicle. It might be a different area code, zip code. It might be a whole nother country, right? If you got to keep more of your tax dollar. So that's what we're going to share with you this evening, how to keep more of your tax dollar, because the truth of the matter is wealthy people in this country and just about any country typically are business owners. Right? Because when you work for someone, and I'm going to share some statistics with you in a moment, you're going to find that it will be impossible, practically impossible to be wealthy, because so much of what you earn, you have to pay in the form of taxes. Just a real quick story. I just, inherited a brand new client who a lot of money on a W-2, a lot, about $2.6 million. On a W-2, and some of it was deferred compensation and some other things in there, but he paid $750,000 in taxes on that 2.6, and after all was said and done, he still owed another 189. So think about that. So almost $1 million of that 2.6 went to the government in the form of taxes. And so that's income earned on a W-2. It would have been a whole different story if this individual was a business owner. So I'm going to share some strategies with you tonight that will absolutely put more money in your pocket. Let's first talk about how employees are taxed, okay? So the first line on your pay stub is income, right? That gross income, whatever that number is. And sometimes that number looks really good until Uncle Sam has his way with you, right? Because now you got to pay federal taxes. That could be taxed up to 39%. You got to pay state taxes. That could be taxed up to 9.6% higher in certain states. And then the next line on your pay stub is 12.9%, which is your self-employment tax, which you split 50-50 with your employer. But if you start adding up these percentages, they're well over half your income. So there's no wonder. So there's sometimes a lot of month at the end of the money, because most of what we earn is withheld from us in the form of taxes. So I call that a clue, guys. Let's talk about business owners. How is that different? Well, the first line, we make money. It's the same thing, right? Business owners make money, employees, they make money or earn income. What happens next is what differentiates us. What happens next is, for business owners, we buy things, AKA expenses, right? And so you'll be interested to know that a lot of the things that business owners buy, if you're not a business owner, you spending the money on the same thing. The difference is, for you, it's a bill. For a business owner, that's an expense. What happens next? We pay tax on what's left. So if you make $20 an hour at work, you pay tax on that $20 an hour. So if you make $1,000 a week, you pay tax on that $1,000. Maybe you bring home $650, maybe you bring home $600 or $700, depending on what you got going on your W-4, but you pay tax right from the beginning. A business owner, when a check comes through from Akana, nobody touches that. You get the whole check. So if you earned $1,000, you get $1,000. No one touches it. What do you do with that $1,000? You buy things or pay for things. We're going to talk about what some of those things are And then we talk about how you pay tax on the difference. Now, there's some common deductions. There are hundreds of expenses. I'm going to hit on just a couple dozen, a little less than a couple dozen expenses that are common throughout home-based business. And when you look at this list, one thing you'll notice is that you're spending money on these things anyway. So every one of us lives somewhere. Some of us, it's a house. Some of us, it's an apartment. Some of us, it could be a motorhome. Wherever that is, you're paying to stay there. And as a business owner, you now get to write off a portion of those living expenses. You've heard it said that, oh, when you rent, it's like throwing money away. Not when you have a home-based business, because now you have a potential tax deduction for where you stay. What about your utilities? Same thing. I'm in my home office. My lights are on. I'm in a cold state. My heat is on. I'm spending money to work here tonight. So you know what the IRS says? They let me write off a percentage of those expenses. I was going to be home anyway, but now I get a tax write-off. Your phones and computers, right? Now it's not who has a phone, is how many phones you have. I'm looking at 3 computer monitors right now where I'm sitting. So we own these things, whether we have businesses or not. Now they are potential tax deductions. Paying salaries and wages. A lot of us, as we start making money in business, guess what? I need a little part-time help. I need someone to do some things for me, and you pay that money out. That salary can go to one of your children, and you get to write it off on your taxes, and then your kids not have to pay tax. That's a whole nother story, guys. We'd have to talk about that another day, but I love that one. Paying your children, showing them how to do business, and not having to pay tax on that money and having a write-off. Your vehicles, right? Being able to write off your vehicles, being able to write off education and training. So if a Akana has a training that you might need to fly to or drive to, what are you doing? Are you saying, oh, you know what? That's going to be a lot of gas money. I don't think I'm going to do it. Oh, that's a $200-300 plane ticket. I don't think I'm going to do it. Guess what? It's a tax deduction. So whatever you're paying, just imagine in your mind that you're paying less because you're going to be able to write that off on your taxes. And even better than that, it's training. It's education. And there are individuals out here that charge thousands of dollars to let you hear them speak, to let them train you on something. And when you're done, you're excited, but you don't know what to do. They've got you all excited, but what's the next step? And people pay thousands of dollars to hear those people speak. You won't pay a fraction of that for your Akana leaders. $10 here, $50 there, $100. That will go a long way. So that's even better than the tax write-off. But guess what? You get both. You get the tax deduction and you get the training. If you decide to market and advertise your business, you get to write that off. Legal and professional services. Now that you have a business, you will seek out tax help that it might cost you more than how much you used to pay to get your taxes done. Well, guess what? That's a tax deduction as well. All of this, every expense in line with your business. Some of them are extremely direct. Some of the expenses are indirect. But the IRS says, you know what? We're going to let you write that off. And I'm going to tell you why. Because at the end of the day, Uncle Sam wants you to blow up. They want you to have a huge multi-million-dollar business. Because when you do that, you help the economy. Think about it. If your business were to blow up tomorrow and you make $500,000 a year, wouldn't some things change? If you didn't have anybody coming in to maybe help clean your home, maybe you might hire somebody. If you were sick and tired of driving, but you could never afford a driver, with that kind of money, you think you might have somebody drive you around? You think you might, if you have small children, invest and pay a nanny to come in and do some things? When we make more money, we put more money into the economy. And so the government knows this, and that's why they allow a small business to potentially come in. You get to write off expenses that will put more money in your pocket that you now get to reinvest in your business. That's what Amazon did. Amazon, you know, most people have heard the story of where they started, but do you know for 11 straight years, Amazon was not profitable for 11 straight years? And look at them today. They're glad IRS let them keep getting write-offs and getting higher tax refunds to reinvest in their Amazon business, because look at how many people they employ now. Most of us probably couldn't imagine our lives before Amazon. So these are the things that we're talking about. So they want you to be a juggernaut in the business. They want you to succeed, because that will flood the industry. What else are you spending money on? Supplies and products, yes. So you might have to buy things, but again, that is a write-off. That is a potential tax deduction. Now, what you want to keep in mind is that there are certain things that you might purchase for resale. That is part of your inventory, and you're going to need to treat that different. And that's why it's so important to have someone who understands your business and understands home-based business in general, to make sure that you're following these things properly, because I just see way too often where it is not done. Internet and cable, right? Without the internet, we wouldn't be able to be on Zoom. So would you say it's necessary for your business? Absolutely. Sometimes maybe we have some storage that we're paying for because we need to put up items for our business. That's tax deductible. One of my favorites, travel. You get to travel and talk about what you do, and ultimately turn your vacation into a paycation. So another wonderful avenue where we can save money on our taxes. Your medical expenses, gifts. The holidays are right around the corner. How many people are going to buy gifts for current clients, future clients, new clients? Many people are going to do that. Did you know that you can write off those gifts on your taxes? Absolutely. Hosting fees. So many of these expenses, if you're sitting here on this Zoom and you are not in business for yourself, with the exception of maybe 2 or 3 things, you're spending money on all of these items. Every one of these items, for the most part, we're spending our money on. What's the difference? When you have a business, it is a tax deduction, which will ultimately put more money in your pocket. When you don't have a business, it's just a bill. And once it's paid, it's gone and it's done. So if you're on the line tonight and maybe you've been in business for a while, but you've heard stuff like, well, you didn't make any money, so you can't deduct that. Or you had a super conservative accountant that maybe didn't even understand home-based business and said, you didn't make any money, so you can't file. That is absolutely 100% not true. So what can you do about that? If in 2022 you had your business and you did nothing, or 2021, or even 2020, we have 3 years to amend our taxes. So that means 2020, 2021, and 2022 can still be amended to go back and add these expenses if you failed to do so when you filed your taxes. 2020, 2021, 2022 can all be amended now. Now, come April 15th next year, that's it for 2020. So if 3 years ago you failed to include your Akana business or any business on your taxes, April is your deadline to file that and get your money. Now, I want to talk real briefly about tax planning versus tax preparation. You see, one is proactive and one is reactive. When you do tax preparation, so once January hits and you start getting stuff in the mail and you start putting it together and you go and you sit with your accountant in February, March, or April, you are going to sit there and have your taxes prepared. And at that point, there's not much you can do because the year is done. You can't plan for it. The year is done. Now, absolutely, you want someone savvy that's going to look for every single thing that you could take advantage of. But there may have been things you could have done prior to the end of the year. That's why tax planning is so important, so that now you are proactive. We got 2 weeks left in the year. There's a little time for, not a lot, a little time for tax planning. What could you do? Did you make a lot of money in your business and didn't spend much? Is it time to buy a car or lease a car? All of those things you need to be talking to your tax professional about, so that you can minimize what's going to happen. No serious, I call it sticker shock when you go and sit with your accountant. Avoiding that sticker shock is so important. And that could be on the positive side and on a negative side. Because you might, sticker shock might be, wow, I'm getting $15,000 back. And you think that's wonderful news, but no, it's not. All it means is that you have allowed the IRS to hold your money for a whole year interest-free when you could have had that money even in a high yield interest account, now that they're paying so much interest. So you want to avoid that, and you want to also avoid, oh, wait, I owe $15,000? I had no idea. That's what tax planning does. It allows you to do that. And that's something that you could do monthly. You can do it quarterly, but you don't want to do it once a year. Especially as a business owner, you want to be more proactive as opposed to being reactive. And the other thing I love about tax planning is too, because now you get to plan for future goals, for future projects. Maybe in 2025, you want to buy a home, right? And now you have a home-based business. And so when you sit down and you plan with your accountant, you say, well, you know what? If I'm looking to buy a home, I'm going to need to show more income. Maybe I don't get as aggressive with my expenses, because once the taxes are filed, that's it. I'm pretty sure someone on this line has heard, you went to go buy something and they look and they see a negative under your business and they're like, yeah, no, you potentially don't qualify to get this loan because it doesn't look like you make any money. And so again, that's where preparation and tax planning comes into play. So when you sit with your professional, they can help guide you in the right direction. So ladies and gentlemen, this is my information on the screen right now. I'll leave it up for about a minute. We're New Century Tax Preparation and Planning and Consulting. I am located in New Jersey, but I do have clients across all of the United States. So we're able to do all 50 states. We currently have about 36 states where we prepare taxes. My email is there, my website is there, as well as my office and fax number. So feel free to reach out if you have questions and you were on this particular Zoom tonight. Please send me an email with that information, as I will be offering some specials for individuals who are part of this group, this organization, but you are able to get a free 20-minute planning consultation with me as a result of being on this call, okay? So I'm here to help as much as I possibly can. We only got 2 weeks left, and I am doing a lot of planning for clients. So get your questions today. Hopefully we'll get some questions answered, but if you have some more questions, you'll be able to call my office and schedule a 20-minute consultation. So I'm going to open it up for Q&A now. Phyllis, I don't know if you're still there. Did you want to start with some questions, or did we want individuals to just kind of raise their hands and they can be unmuted and I'll answer questions?
They can raise their hand.
Okay.
Rochelle, I see has her hand raised. Hold on. Get her. Okay, I unmuted you, Rochelle.
All right. Well, first I want to say thank you for such this web, such a inviting and a lot of information you just shared with us. I love to hear that information. I've heard it a couple times, but you went into depth. But something I did a few years ago, I went to a training. I think I was thinking about going into real estate, and they were talking about some of the same things. And is it true or is it not true that technically we really don't have to pay taxes if we know the ins and outs? Is that really true?
What did you say before that? The ins and outs, you said something and it went out. Technically, was that the word you used?
Technically, you don't have to pay taxes.
Okay. So no, you live in this country, you work. Generally speaking, we are responsible for paying taxes. But what can happen is an individual, especially one who's in business for themselves, you can do enough business, you can earn a whole lot of income on one hand, and then turn around and spend all that income you earned on the other hand, and now there's zero left. And in essence, you won't pay any tax if that's the case. So if you're good with your expenses, so a person, you can earn $100,000, but you can turn around and spend $100,000 as well. That leaves zero. So business owners earn income, they buy things, and they pay tax on what's left. If there's nothing left, then no, you don't pay any tax. So that is technically true, but understand that if you are working and you have a W-2, a few years ago, there was something circulating that, taxes aren't really the government and it's a private agency and you don't have to do that. Man, the IRS got a hold of them people and it was not pretty. But with your business, it's doable. I'll put it that way.
Any more questions, guys?
Nadine.
Nadine. Nadine, I'm unmuting you. Click on your, okay.
Thank you.
Uh-huh.
Okay, hope you feel better, Phyllis.
Thank you.
Listen, my question was, is there something that senior citizens have an advantage of as a home-based business that we need to know and utilize, like 75 years old?
So unfortunately, in this country, they say if you make money, you're going to pay taxes until you die. So your age doesn't necessarily give you any additional tax advantages, with the exception of you get a higher standard deduction when you're filing your taxes. So based on your age, you can get a higher standard deduction. When it comes to collecting, say you're collecting Social Security and working at the same time, you won't pay taxes on you'll never pay taxes on 100% of your Social Security. So sometimes seniors say, well, if I make XYZ dollars, then I'm going to have to pay tax. What I say is never sacrifice making money for something like for taxes. Make the money. If you have to pay an extra 10 cents, 20 cents on a dollar, do it. I'd rather make $1 and pay them 20 cents. I'm still up 80 cents.
Okay. Thank you.
You're welcome.
Okay. Who is that? Brenda? I'm unmuting you. Brenda Snar, you're unmuted. Well, you got to do yours. Okay, there you go, Brenda.
The question I have, is it possible that you could put the what can I deduct slide back up for the second one? I got the first one, but I didn't get the second one. Is it possible?
I will put that back up. Yes, I'll put
Thank
that
you.
back up. There are a couple of questions in the chat. So let me address those. So I think I see, can you discuss the new law regarding business owners listing all owners? Yeah, that's new for 2024. It's very, very simple. It's just a document that you're going to need to sign that lists the owners because of what's the money laundering and stuff like that that's going on, and they just want to account for all businesses. So it's just something you're going to need to just sign, verify the owners. I haven't seen a copy of it yet. I have done some reading on it. I'm supposed to be attending something at the end of this week on this Friday to get a little bit more information on it. So once I do, I think that's Tamar. Tamar, email me and then I'll make sure I'll get that information to you by this upcoming weekend. But yeah, it's nothing. I mean, people make it out to be like it's this big thing. No, it's not. It's going to be a simple document that you're going to verify that you have a business and you list the owners' names, and that's it.
Abner?
Yes. So Abna says, you mentioned buy for resale. How does that work? We purchase product in our packages. How does that benefit when paying taxes? Okay, so there is a difference between the products that you buy for resale and the products that you may use for marketing. So what do I mean by that? So if I purchase something that I'm going to sample out, and I spend $50 on that, and I'm sampling it out, I'm giving it away, I'm using it that's a marketing expense. That is a tax deduction. And when I spend that $50, I'm going to write off that $50. I get to write that off. Now, let's just say you pre-buy stuff, right? And you buy it at a wholesale price in order to sell at retail. That is considered your inventory. And that inventory is an asset. It's not an expense. And it stays on the books until you sell it. So now we take that same scenario. If you bought inventory that was $50, you plan to sell it for $100. When you buy that $50 worth of inventory, you don't write that off, simply because you're holding it until you can sell it for $100. And when you sell it, that's when you recognize the income of the 50 as well as the cost that it costed you. So if you're buying something for resale, so a person might decide, all right, it's the end of the year, I'm going to buy $10,000 worth of product so that I can sell next year. You don't get a $10,000 write-off. You don't get to write that off as an expense. Why? Because that is something that you are holding for resale. If you took $10,000 and you did a marketing campaign and you got an advertisement on a billboard, that's a $10,000 write-off. That's the big difference. So a couple of slides, amend your taxes, contact info. So why don't I do that? Let me see if I can back up here. I might have to stop the share. I'm going to stop the share because it won't let me back up, looks like. Oh, yes, it will. Okay, so let's start with, here is my information. Here's my contact information. I'll leave that up for a few seconds. You can take a picture of it or write it down. That is my office number, my fax number, my email address, as well as my website. Okay, so we're going to
pass her hand up. So let me unmute.
Okay.
Dr. Roz.
I'll leave this screen up while we ask the next question.
Dr. Roz, you can take it away.
Thank you. Thank you, Ms. Webb. Thank you. Thank you. Thank you so much for the information you've shared with us tonight. It's going to be invaluable to our nation. The question is, when you have a situation where you are the sole proprietor business owner like we are here, and also my husband is working on a job, tell me how we combine all that together, because we normally file together. We normally file joint. And I've been writing off, I learned some of this information and I've been writing off everything. So, but I just want to make sure I'm doing it correctly as it relates to him on with his W-2.
Yes, so that's fine, Dr. Ross. So what happens is your husband has a W-2. It appears on the 1040 on line 7 as his total income, right? So now a few lines below that, you're a sole proprietor and your items go on a Schedule C. So you report all your income there, and then you report all your expenses, and then you come out with a net number. If it's a net profit, let's say that net number is $50,000. That now shows up on page 1 of your 1040. So now combined, you and your husband have $150,000 that you're going to pay taxes on. Well, after the standard deduction and all that. Let's say it was the opposite. Let's say you wrote off everything. You made all this money, and then guess what? You wrote off everything to the point where, you know what? You wrote off more money than what you made. And let's say that's a negative $10,000 as opposed to a positive $50,000. That negative $10,000 flows onto that first page of the 1040. Your husband, let's say that line 7 is 100,000. Now your line is minus 10,000. Now you pay tax on $90,000. So losses in your business offsets your husband's W-2 income, thereby increasing the refund. And generally that is what happens early in business. When you're in business a couple of years, you spend more than you make. And that may sound scary, but the reality of it is, you remember when we listed all those things, a lot of the stuff that you're spending, you were going to spend it anyway. Now it's just an expense in your business. So often you end up with a loss. That loss offsets W-2 income, thereby increasing, it either increases your refund or it reduces what you would have had to pay the IRS.
Got it. Thank you.
You're welcome.
Marsha, how many more questions are you available for?
I got 7 more minutes before my next call, so probably another 2 to 3.
Okay, I see a message from Valtrice, I think. Is there a Valtrice out there? What is the rule for mileage in business? That's what her question is.
Okay, and then I saw another one before
My
that.
Mitchell. My Mitchell.
I'll go back to it. So the rule is you're either going to do actual business actual or mileage. So what that means is for mileage, you're going to drive your car, you're going to record the miles that you do for your Akana business. And if that's 2,000, if it's 10,000, if it's 20,000, you will take the standard mileage rate and multiply that and get the deduction. Now, what if you wanted to do actual instead of standard? You will still need to track the miles because you're going to have to determine what percentage of your car you're using for business. And so if your total miles driven this year, 2023, was 20,000 miles, and when you do your paperwork, you say, well, of that 20, 10,000 was for business. I have 10,000 business miles. That means 50% of your gas, of your repairs, of your oil changes, your car washes, 50% of that would be tax deductible. And then you'd be able to depreciate that vehicle to the tune of 50% as well. So you could only do one. 50%, you could only do actual or miles, one or the other. You can't do both.
And we're going to close out with my Mitchell. My Mitchell, are you there? Let me see if I have to unmute you. Dr. Ross, do you see my Mitchell?
I don't. I do see a question in the chat. What does the accountant need for us to bring when we go to them for an initial visit? That's a loaded question. It depends on how much else you have. So I would say if you were really good at keeping accurate records, I would say some type of spreadsheet which has what your earnings were and what your total expenses are. That's what I would recommend. Aside from all the extra paperwork that you get that says all important tax documents, if you're a homeowner, your mortgage interest and your property taxes and your W-2s. But for your business, I would say that you would have some type of spreadsheet together. If you're not using QuickBooks where you can run a P&L or a balance sheet, some type of spreadsheet or something that shows, hey, this is what I made and these are the expenses by category that I had. Now, some people need more help with that than others. So depending on the accountant and how much time they have, maybe they'll tell you, bring me your bank statements. But that really depends on how much you have going on with your business.
Well, Marsha, I can't thank you enough. I think everybody here is so pleased with the information they received tonight. And again, I'm glad we made that connection last week. I said, oh my God, we don't have much time. So thank you so very much. Guys, thank you for joining us. I know this was invaluable to you guys. And I'm glad I got to host the call no matter how terrible I sound. So I apologize, y'all. Okay, with that being said, Marsha, thanks again. We'll talk later for sure.
Sounds good. Take care, Phyllis, and good night, everyone.
Okay, bye-bye.